Hello, everybody, and welcome to one of my favorite webinars. And personally, I think one of the most important ones. My name is John Bodnar. This is Investing 101, a 1-hour intensive course on the timeless investment principles that have guided me in my 35 plus years in this business. The philosophy we're going to outline tonight is rooted in historical market data. It serves as the foundation of everything we do here at Bodnar Financial. I used to give this webinar really as a half-day workshop, but tonight we're going to cover all this information in an hour. So strap in. We're going to go through a lot of stuff. But before we dive in, a few housekeeping items. Number one, you are all muted. So stop hitting the little button to try to figure out if you're going to ask me a question. All right. I wouldn't mind some questions, but you're all muted because I don't need to hear Justin's dog in the background or my grandsons who are Karen's babysitting say, there's Paw, right? Or the guy blowing the leaves outside my office right now, of course, at like 4:29 he started. So everybody is muted. Number two, we are recording this. So I think we're going to be posting it on the website, but it has to get approved by the compliance police and everything else. But we will be posting it at some point. So if you have friends, family, coworkers who want to witness it, that'll be great. People are still joining this meeting, but when we're all up and running, there'll be probably about 75 of you. So thanks for taking the time. I can't believe it. If we had booked a room at the Park Avenue Club or something, I would have had got a bigger room. And last but not least, thanks to the team here at Bodnar Financial. I couldn't have done it without them fielding all the calls this week as I was trying to put this together. Lorraine and Jane and Danielle, my right-hand man, Justin, but most of all to the executive producer, Jackie B. Writing, my daughter. Really, thanks so much, Jack. All right, so let's do this. Let's jump in. Let's go to the next slide, Jack, right? So I can't think of a better time to really revisit these first principles than right now, right? Today was a great day in the stock market, but the last several months, pessimism has been unbelievably high. In fact, some metrics, some of the studies have been done say it's at an all-time high. We've never been more pessimistic. So we got inflation, we got stock market volatility. Nearly every CEO in America believes that we're heading into some type of recession sometime in the next 12 months. So of course, now is a perfect time to get back to the basics. Remember why we're here. While the rest of the world gets fearful, we're going to get philosophical, right? So strap on, strap in, let's dive right in. The first thing we need to do is leave all the current events at the door. All the market worries I just pointed out, forget about them for a while. I'm going to close the door on them. We're going to leave them outside because the principles we are talking about tonight are timeless. These are not like marvelous brand new ideas that I just thought up, right? Everything we're going to talk about tonight was true during World War II and after World War II. It was true during the 1970s oil embargo and stagflation. It was true during the dot-com bubble. It was true on 9/11 and the Twin Towers. It was true during the financial crisis. You name it, right? They're timeless. I'm going to leave all the current events at the door. We're going to wipe the slate clean. We're going to start over from the most granular fundamentals, and we're going to start with some definitions. All right? 3 definitions here. Number 1, money. Money, right? What is money? Money is purchasing power. You use money to pay for goods and services and to help achieve your life goals, right? No money, no goods and services. Very hard to achieve life goals without money. And your purchasing power is fighting a never-ending war against inflation. Inflation is the decline of purchasing power over time. The average annual rate of inflation is just under 3%. We're going to be revisiting that number technically it's 2.9, okay? We're going to be revisiting that number a couple slides from now. But what does that inflation of 3% mean? It means that $1 this year will only be able to buy the equivalent of 97 cents next year. Technically, those things don't cost more next year. It's just that your dollar is buying less of them. So as we know, inflation can climb higher than 3% sometimes, like right now, right? Inflation's a killer right now, right? We ended September at 8.2%. Sometimes inflation is a lot less. I mean, really, the decade that followed the financial crisis, the Fed was worried that there wasn't enough inflation. Now we're worried that there's too much inflation, right? But inflation is a cancer. Inflation is a killer. All right. In investing, definition number 3, is the act of putting money away for the far distant future. We at Bodnar Financial are not day traders, as any of you who have worked with us over the years know, right? We believe in disciplined, long-term investing. We help people create balanced portfolios that work in order to fund 30-year retirements, 3 decades, right? And to help fund family legacies. When we say investing, we're talking about the long haul, right? We're not talking about something you buy today and sell tomorrow. Now, what's the goal of investing? Right? Why invest? Why are we here? Because investing fights inflation, right? Our minimum goal as investors is to earn a return on our money that at the very least, at the minimum, offsets income taxes and inflation. Because if we don't, money decays, right? It actually decays over time. That 3% inflation compounded over 30 years destroys 60% of your purchasing power. So that bag of cash that grandma or your Aunt Norma used to hide under the bed, that bag of cash, that wasn't sitting there all those years. It was decaying. It was literally decaying away. So how do we fight the decay? How do we fight inflation? Well, we take advantage of the miracle of compound interest, right? Again, any of you who have worked with me over the years have heard me say, right, the 2 most powerful forces in the universe, compound interest and time, right? The greatest ally every investor has is time. Compound interest is the financial miracle that lets you collect interest on your interest over time, all right? Here's an example. Let's say you have $100. You take that $100, you put it into an investment account that provides a 7% annual return. That means that you can expect to earn around $7, $7, or 7% on that $100 in interest if you left that money alone for 1 year. So after 365 days, your account will grow from $100 to $107. Now, here's where it gets good. If you keep your money in the account, you will earn 7% interest again. And this time on your new total of $107. You are earning interest on your interest, called compounding. 7% of $107 is $7.49 of interest earned. You got a little bit more in year 2, more than you got in the prior year. Now you have $114.49. And if you keep it in there for another year, you'll earn interest on that, and so on and so on and so on, right? Great, right? That is the concept of compound interest. Now let's see what happens when you combine compound interest with time. Maestro, next slide. Thank you very much. So let's say that you keep that $100 in the investment account with a 7% annual return for 50 years. All right, your total will grow to $2,946 by the end of those 50 years. And that's just $100. If you look at the bottom, you see that those little blue boxes at the bottom? That's and they never change, because that's the original $100. That $100 over the years is compounding, 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 and that $100 grew to $2,946. All right. Now, imagine for a minute that instead of $100, you started with $10,000. After 50 years at a 7% annual return, your total would grow to $294,571. And that's just what happens when you make one deposit, one time, and you let it sit. Now, let's see what happens if you decided to take $150 out of your pocket every month or out of your paycheck, and you put it into this investment account every month during your working years, right? Boom. Or as they say on the old Batman, kapow, right? Kapow. We should have a graphic there, Jack. Kapow, right? You are a millionaire. And you didn't even have to make $1 million to become a millionaire. When you look at this, you actually just had to make 100,000, because that's how much you deposited in small increments over the course of that 50 years, right? Like I said, compound interest is a financial miracle. When people talk about investing, you may hear the phrase with earnings reinvested. If you were here in the office right now, I got my little air quotes going. With earnings reinvested. This is what that means. You are taking your earnings, the interest made from your investment that year, you are keeping it in your account to compound year over year over year over year. All right. So, I mean, this is it's simple, but it's powerful. You're a millionaire, but you didn't have to make $1 million to be a millionaire. You really only had to invest $100,000 over time. And that 100,000 grew another 926,000. You have a little over $1 million. You are choosing to let it compound rather than taking the cash, which makes you smart, right? That's smart. Charlie Munger. We love Charlie Munger. Charlie Munger, Warren Buffett has the best one-liners, but there's only one person who has better one-liners than Warren Buffett. And that's Warren Buffett's original partner, still to this day, Charlie Munger, right? And Charlie says, the first rule of compounding is to never interrupt it unnecessarily. That prior slide is the proof of that, right? Now, different types of investments compound at different rates. And I want to make this clear before we go any further. The range of alternative investments has never been wider. When Charlie Munger and Warren Buffett started Berkshire Hathaway, they weren't, there weren't people out there buying cryptocurrencies and real estate in the metaverse and NFTs and all these other things that are out there, right? But that's all available today. So you have a lot of alternatives to invest your money in. But tonight, we're going to be talking about investing in companies, the great companies of America and the world. As we do this, we are going to use a series of numbers to guide our discussion, all right? And we call this our user's guide. Some of you have seen this over the years. Sometimes because I like to talk so much, I don't have time to run through this with all of you in the financial planning meeting. It's one of the reasons why we're having this webinar tonight. And also, it's a good refresher for those of you who have heard it and seen it before. Some of you will recognize these numbers, all right? You'll recognize and you'll realize that these numbers are not just pulled out of thin air. These are the engines that drive the capital markets. Now, if you have a piece of paper in front of you, all right, I encourage you to write all these numbers down right now. Maybe you can use your Bodnar pencil that we mailed out back in the beginning of the year. And we can do this exercise together, right? Write these 2.9, 3.6, 5.1, 10.3, and 12.1. Now, once you write those down, this is where we could cue up the Jeopardy music, Jack, right? But But the first thing I want you to do with these numbers is I want you to write a percentage sign after all of them. Okay? These are percentages, right? These percentages are the average annual returns of the major capital market classes from January 1st of 1926, that date purposely chosen so we can pull the Great Depression, the big one, into this discussion. I don't want to make believe that never happened, right? So these are the average annual returns, January 1st, 1926 through December 31st last year, December 2021. These are the average yearly returns of the 5 most important market components. We are going to start at the bottom and work our way north. All right. Now, just like the planets revolve around the sun, because we had this unbelievable lunar eclipse the other night, if any of you saw it, the blood moon, right? Just like the planets revolve around the sun, this 2.9% at the bottom here, that is our sun. That's our sun, all right? Sun with S-U-N, not S-O-N, right? That sun is the reason we don't leave all of our money in a near zero interest savings account or hide our cash like our aunt or grandma under our beds or bury it in the backyard in the mason jar like my grandfather used to do, all right? 2.9% is the acronym of the acronym we use for this, right, is CPI, right? Consumer Price Index. What is the CPI? CPI is the average annual rate of inflation. And the average annual rate of inflation from 1926 to 2021 is 2.9. Earlier, I said 3%. I rounded it up to 3. Now, let's look at the next one, 3.6. This 3.6 is the average annual return of a treasury bill. We refer to it as a T-bill, right? You hear that phrase thrown around. Now you're going to know what the hell a T-bill is. A T-bill is an IOU from the federal government. You're taking your money, you're going to loan it to Uncle Sam, and Uncle Sam is going to pay you back with interest at a rate that barely outpaces inflation. This is essentially a risk-free return. We use that phrase in the investment business all the time. What is the risk-free return? The risk-free return is based on whatever the current T-bill rate is. Now, why is it a risk-free return? Because the government isn't going to default. If it gets close, it just prints more money. Okay, that could be problematic, but that's another webinar for another time. But there's no default risk. The government isn't going to default. There's really no inflation risk, right? Long-term, there might be inflation risk if the government prints money, but not for your T-bill because the maturity date's only 1 year, right? So it's a 1-year IOU. That's a very short window of time. So you don't have default risk. You don't have inflation risk. So since you're not really taking any risk, you don't get much of a return, but that's what you get for not taking much risk. That's the way the markets work, all right? Now let's look at the next one, 5.1. All right, we're starting to earn a little bit more. Now we're moving from treasury bills to something called treasury bonds. Well, what's the difference? They're both issued by the treasury, but now this is not a 1-year IOU, right? These are, 5, 10, 15, 20, even up to 30-year IOUs. The government, the U.S. Treasury issues all different kinds of bills and bonds, right? These are longer maturities. Tying my money up for a longer period of time. Now I have some risk. So now you have interest rate risk. You might buy that bond today. And what if tomorrow the Fed raises interest rates? Interest rates go up and you're stuck in this 20-year bond at the lower interest rate. You've taken some risk. And as you can see, the average return is higher than the T-bill to reward you for taking that extra risk, right? Makes complete. This escalation of return from south to north makes complete sense to me, all right? Now, if you're writing this down on a piece of paper, you draw a line. You draw a line between the 5.1 and the 10.3. All right. And next to the word treasury bond, you can write the word loaner. Loaner, loaner. You are a loaner of money. Below that line, these three asset classes, you are a loaner of money because you're taking money out of your pocket and you are loaning it to a government or to a company. You can buy, and here we're talking about treasuries, but you could buy an Exxon bond or an Apple bond. You could buy a Madison, New Jersey tax-free municipal bond. There's all sorts of bonds out there. But when you hear the word bond, you immediately say to yourself, IOU, IOU. That's what a bond is. You take your money and you're loaning your money to a company or a government, all right? So below this line, you are a loaner. Well, what about these last two asset classes above the line? Above that line, you can write the word owner, right? You own things. You don't loan things to entities. You own them. If you're in this investment class with the 10.3 return, you are an owner of 500 of the largest, most successful businesses in the world. This is the asset class known as U.S. large cap stocks. Stocks, you own ownership, equities. The acronym we use to describe this category is S&P 500, Standard & Poor's 500. These are 500 of the largest stocks in the United States of America. 500 are the savviest, smartest, well-run, highly capitalized businesses in the history of the planet Earth, right? And then you get to the top dog. You say, whoa, what's this 12.1? Well, 12.1 is U.S. small cap stocks. The acronym we use for that is NASDAQ, NASDAQ, right? If you really wanted to invest in that, there's an ETF called QQQ. That's why it's QQQ, because of NASDAQ. Every one of those big companies in the S&P 500 started over here in 12.1 land as small cap stocks in the NASDAQ, right? Apple wasn't formed and just overnight became the largest capitalized company in the world, right? These NASDAQ stocks grow at a higher rate of return because there's more risk. Not all those entrepreneurs with the companies that they started in their parents' garage, not all of them make it, right? Henry Ford started in the garage. Apple, Jobs and Wozniak started in the garage. Hewlett and Packard started in the garage. America has a great history of starting things in their parents' garages or out back in the shed, all right? But there's plenty of companies that didn't make it. For the ones that do make it, eventually, as those companies get a little more mature, they start paying dividends. They start providing returns a little less than what they did when they were the up and comers. That means there's a little less risk. So the return goes down with it. All right. But here's that line, right? There's that line in the middle of the page. These top two investment classes are the owners. That's the takeaway from this slide, right? They're the owners above the line, and below the line, you're the loaner. So when you buy a share of one of these companies, you now own a piece of that company. You now own, let's say, a small piece of Microsoft, as opposed to if you own a bond, you're just part of a big consortium of banks and people that loaned Microsoft money, right? Owner above the line, loaner below the line. So remember, as investors, our minimum goal is to earn a return that offsets the effects of inflation, right? That's our goal, right? So these percentages in reality are those values minus the 3%, right? So, and remember, after inflation and sometimes taxes. So, we could do three columns here: average return, consumer price index 3%, treasury bills 3.6. All right, you earn 3.6. You got to back out 3% inflation. That means it's really 0.6. And then If it's in a taxable account, you back out taxes at whatever your bracket is. You could put one of those sad faces technically in that box, just like we did in the one that says consumer price index, right? Right? Inflation should always be a steady drumbeat in the back of our minds all the time. Bang, 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 bang. Inflation, 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 right? So here's our list. We have the basic asset classes. And remember, these are the engines. But what do these moving parts really mean in dollars and cents, right? All right, so now we're going to get a little wonky, and I'm going to start giving you a little bit of inside baseball here. So take a sip of that glass of wine, hopefully, that you have here as John Bodner's rattling on. Okay, so the CPI, the rate of inflation, has averaged 2.9% since 1926. What does that mean, right? Okay, it's 2.9. That means if great grandpa, or in my case, I'm old enough where in 1926, it's my grandpa, not my great grandpa. If my grandpa had put away $1,000 for me on January 1st, 1926, for his yet to be born grandson, that $1,000 would be worth $15,653 today. That is the value of compound interest at the rate of inflation over that period of time. All right. Now, if great grandpa had put $1,000 in T-bills on January 1st, 1926, that would have grown to $29,580. So you look at that for a minute and you go, that's pretty good. 15,000 or 30,000. I'll take the 30. Thank you very much. That's quite a jump, right? That is the miracle of compound, right? Now, let's look at $1,000 invested in treasury bonds in 1926. You'd have 118,103 technically, right? Now, when I do the workshop, I've done this many times, and we take more time, and I actually hand out compound interest tables. We have a couple calculators, and we hand out the pencils, and people, I have them actually do the math, right? This is where somebody usually looks befuddled, or they raise their hands. They ask me if they're doing the math wrong. Am I doing the math wrong? Maybe there's a typo. And I go, well, what do you mean? And they go, well, this doesn't seem to add up to me, Mr. Bodnar. At 3%, the money grew, the CPI money at 3% grew to 15,000. And then you're telling me at 5%, which isn't even double the 3%, that rather than having 15,000, you have 118,000? Wouldn't like double the 15, like since the money's double, the 15,000 would just be like 30,000, but instead you have $100,000 more. Is that accurate? And I go, yeah, it's accurate. Yeah, it's just math. It's that miracle of compound math, right? We can go to the table, right? We can do the math. That's where it's so incredible, right? When you really try to wrap your head around this, you go, wow. And it's not even double. It's 3% versus 5%. But what's really incredible is what you're going to see on the next slide, because you ain't seen nothing yet, right? These are the loaners. These are the loaners. The three categories of loaners. Jack, go to the next slide. 10.3. That's not a misprint. Wait a minute. 12,342,456. And again, that's not investing $1,000 a year. That's grandpa putting away $1,000 once on January 1st, 1926, and it grew to $12 million. So as investors, right, here's the epiphany moment, light bulb, bing, right? We have a binary choice, like A, B, yes, no, left, right. We have a binary choice. We are either going to, one, lend to companies and be a loaner, or we're going to step up, cross the line, and we're going to own them outright. One of the two. You have a choice. Pick your choice, A or B. The difference in performance over time is crazy dramatic, right? It's crazy dramatic. So another question, why would the investment gods reward one class of investor, the owners, so much more than another, right? Is it fair? How can that be fair? Why would the investment gods do that, right? $12 million versus 15,000. How can that be? Here's the reason, right? Because those investors above the line they consciously decided they wanted to be owners. And they were willing to sit through market sell-offs once every 3 to 5 years on average. But we're going to do a bear market seminar. I'm going to give you a little data here in the next 5 or 6 slides, but we're going to do a whole webinar on why bear markets are necessary. All right. But back to why are these owners, why are the investment gods making these owners so rich? There's got to be a price tag, right? The price tag is that these owners are willing to sit through a sell-off once every 5 years or so and watch approximately 25 to 30% of their capital just go poof, technical term, poof, and just disappear over a very short period of time, but then it comes back. But while it's gone, you want to throw up in a garbage can because you feel so bad and sick over it. Okay, that's the price. That's the emotional price that owners pay. And you know what? Not everyone has the stomach for it. Easy for me to talk about it, not easy to live through. When you look at the Ibbotson chart, you see the big picture. You see all those dips and those drops, and they don't look so bad. They kind of look small. Remember, most of you have seen this chart or something like it on my wall over the years, and most of you have a chart that looks like this in your financial plan. All right. And I come into the office every day and I pledge allegiance to the Ibbotson charts. I believe in the Ibbotson charts, right? But let me tell you, while those little dips and drops that don't look so awful on the Ibbotson chart, right? But while they're happening, it feels like the end of the world, right? I mean, we just went through one of them. It doesn't feel good, right? How about the Great Depression, which I talked about, right? How about Pearl Harbor? How about JFK assassinated? How about an oil embargo, in 1970s and stagflation? How about September 11th and the Twin Towers? And any of you who visited my office know I have my little 9/11 shrine on the wall here, right? How about the financial crisis? How about the pandemic that we just went through, right? You don't feel good during any of those periods. And if you focus on the days and you lose faith in the trend line over the decades, things can start to feel pretty intense. But when you zoom out, when you step back, like I am right now, right? When you step back and zoom out and you look at the big picture, you realize these dips are completely normal. We know, everybody knows, we all know that bear markets are coming. It's not an if. It's not like, oh, that's it, we're never going to get a bear market again. Of course we are. You're going to get them for the rest of your life, right? For the remaining time until the apocalypse, right? Bear markets are coming. We just don't know when they will arrive. We don't know when they will end. So, wow, that's kind of tough to live through. I go, yeah. But history tells us that markets tend to roar back as sharply as they dropped. You don't get windows of time to leisurely return to the market. That's why it's so important to buy and hold. Stock owners, truly successful stock owners, keep the faith in the trend line. They sit through the dips. They focus on decades rather than days. And the investing gods tend to reward them accordingly. So, Ibbotson chart on the left, on the right is this little doodle. that my man Justin actually brought to my attention over a year ago, right? I loved it so much, I literally ripped it out of the thing he and I were looking at, and it is pinned on my corkboard. That is not a photoshopped image. Jackie B actually took that with her cell phone. It is on my corkboard over my shoulder right now as I'm doing this webinar with you. I keep this doodle on my pin board at the office on purpose. I love it. Days versus decades. Successful investors tune out the days and focus on the decades. I think that little doodle is one picture of this entire. Now that summarizes this entire webinar, right? And you as an investor decide which to focus on. You want to focus on the days, you want to focus on the decades, right? So here's your mantra, right? The advances are permanent, the declines are temporary, right? Get in your yoga, your favorite yoga position, and repeat the mantra, right? Hum, hum. The advances are permanent, the declines are temporary. The advances are permanent, the declines are temporary. Repeat 3 times, right? Temporary declines are not permanent losses unless you decide to make them so, right? You, the investor, make them so by panicking and selling at a low point. Let's break this point down even further because this is real. Honestly, this is the mantra. This is the moral of the story, right? The advances are permanent. The declines are temporary. This means, and you've heard me say this a million times, the stock market always goes up. It just doesn't go up every day. Look at the Ibbotson charts, right? There's your proof. The stock market always, do you see a trend? Can anyone notice a trend in this almost 100 years worth of history? Yeah, the lines trend from left to right, upward, but they just don't go upward every day, week, month, or year. They zig and they zag on their way up, but ultimately it's up to you what perspective you're going to link your emotions to. Back to the doodle, right? Here's the doodle, like off of Yahoo News or something, right? You know, this is the official version of the doodle, right? Days versus decades. This is what it looks like in real life, honest to God practice. You could look at a 5-day history at a glance on wallstreetjournal.com, right? That's the 5 days. What 5? I don't even know what 5 days there were, but they're 5 days, right? And you see that steep decline, and you think that looks pretty bad. You know, I don't want to fall off that cliff. Or you can zoom out and take a 40-year view of that same index. That's the S&P 500. They're both the S&P 500. One is the S&P 500 over 5 days, and the one on the right is the S&P 500 over 40 years. And when you look at the one at decades versus days, you realize that cliff you thought you were going over, it's really just a tiny little hiccup. It's a hiccup on a tremendous growth path, right? So what do we have here? We have a summary, right? I have summarized the hiccups. Here's the hiccups, right? It's technically called bear markets, right? Right? And again, we're going to take this chart. I don't know if we'll get to it this year, maybe in the spring, but we have a bear market, an hour on just bear markets. And we're going to really drill down into this chart. But here is every bear market in post-World War II America, 1946. Now you can look at these numbers and you can frame it, again, kind of binary, one of two ways. Your choice, you get to pick, right? One, you could say that, as we emerge from the most recent bear market, by the way, there's 13 of these, right? So if you go to the bottom one, right, and you say, okay, maybe the low, it appears that the low might be October 12th, 2022. Maybe that was the low, right? And that low ended up at 3,577 for the S&P. that price sits 1,000 points below the S&P high we saw in January of 2022. You go, oh my God, the market dropped over 1,000 points. When you put it that way, it sounds pretty bad. Or you could look at that and say, our latest bear market bottom, that 3,500, the trough price, that's 250 times higher than the 1949 price. If Grandpa bought that 73 years ago and held on, that's one heck of a gain, despite all those crazy events in the last 73 years, right? Prices, stock prices in the S&P 500 are 250 times higher, right? From 19, the S&P was 19. Today, well, it was 3,577. Today was a crazy day, right? It was up. Today, we almost broke 4,000, believe it or not, right? Right? So, it doesn't go up every day, but there's no doubt when you look at the big picture, it went up a lot. Or if you feel that's too extreme of an example, the 73 years, you could notice that our market bottom right now is still double the value. Look at the second blue chart, blue box from the bottom. It's double the value of the market price 15 years ago. And the reason for that gain is because that's about how much corporate earnings have gone up in these 75 years or so. This is not a casino. I use a casino example sometimes when I talk with folks, but the stock market is not a casino. Stock prices long-term are determined by company earnings. Human emotion may drive stock prices day to day over the short run or week to week, but over an investing lifetime, the value of companies is determined by their earnings. It's that simple. And as earnings go up, stock prices go up, and owners get compensated for it, right? So we know that the advances are permanent, right? I just proved it to you, right? But the declines are temporary. We know that time's our greatest ally. We know that compounding should never, ever, ever be interrupted unless you really have to. Thank you, Charlie Munger. We know the strongest investment strategy based on all this data is to own a piece of good companies and leave those investments alone, no matter what CNBC might tell you during a commercial break. So intellectually, we all know this, all right? And I keep telling you this over the years. So why does a bear market cause people to lose faith, right? Why does it feel so bad? And why does a bear market cause us to lose faith, abandon our long-term investment plan, and sell out in a panic? And I'm going to tell you why, all right? Fear. I hope that wasn't too loud for all of you. It's a 4-letter word, fear. It's fear that does it. And it's not our fault. We're human, right? Human nature is a failed investor. It's in our DNA. We, ladies and gentlemen, who are on this webinar, we're the survivors. The mere fact that we're alive together right now, we are the survivors. We are the children of every interaction where fear and terror were rewarded for the last 10,000 years. When 2 cavemen walked out of their caves and they heard a rustling in a bush over on the right, one of the guys, the brave guy, ran right over there, went over to investigate, while the other guy, he peeled off to the left and was scared, and he hung back and he hid behind a tree. The guy who peeked around the bush, he got eaten by a saber-toothed tiger. The other guy, the big chicken, buck, 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 hiding behind the tree, he actually survived. He's our relative. We're from his food chain, right? He was rewarded positively for his cowardice, right? We are the descendants of that guy. We are wired internally. Our brains, our stomachs, our bodies are wired to react to our fear in order to survive. Now, each bear market creates fear. Each bear market feels uniquely different as we live through them. No 2 bear markets are exactly the same, right? and I'm not downplaying this, believe me, current events are genuine disasters, right? Who lived through the pandemic without feeling like the world was going to end at least once, right? I mean, I did a couple of times, right? We all felt that way. The individual circumstances in each case are just different enough. In those 13 bear markets, right? The individual circumstances in each one of those cases are different enough to frighten the bejesus out of us and to frighten us into thinking that the long-term trends of economic progress are over and the growth of earnings and dividends are over and it's been permanently shattered and that it's never going to be the same again, at least not during our lifetime, because it's different this time, Bodnar. It's different, right? Granted, I will grant you that indeed each bear market in the past was brought on by a serious, and I mean a serious, economic and geopolitical problem, which had no exact precedents and were therefore very, very difficult, if not impossible, really impossible to analyze at the time, because each one is just a little bit different enough. Say, well, this has never happened before. But they all had one critically important thing in common. All right. When we were collectively going through them, it was impossible to say how they'd get solved, but in time they all did get solved. That's where they're all alike, right? The fact pattern leading up to the crisis was different, but they all got solved. That's what they all had in common. Every single one of those 13 bear markets, it was rough, but guess what? Every one of them got solved, right? And you didn't have to know how they were going to get solved. Like Harry Truman used to say, right? There's no facts about the future. And there aren't any facts about the future. But if you had maintained your faith based on the history of all prior crises and bear markets that they would get solved, then you were saved. So knowledge of how any current crisis will be overcome is always unavailable to us. There are no facts about the future, as Harry said. Faith that it will be overcome, a faith that's based firmly on the historical record, is always limitlessly available to us. Just pick up the history book. In a very real sense, your lifetime investment returns. As an investor, your returns may depend on where you come out on this binary issue. Do you have faith, or are you gonna jump? Say, nope, it's different this time. So here's my advice, right? In a crisis, I don't look for answers in economic commentary, because you're not going to find it there. You're not going to find it on CNBC or Yahoo News or some other website. Consult history, all right? History. What does history tell us? History tells us that we have to sit through sell-offs once every 5 years and watch about 30% of our capital just go poof, and then watch it come back. But we don't know exactly when. And then you got to sit through a 50% decline every two or three times a century. And in fact, if you were born before January 1973, you've lived through 3 of these episodes where the S&P 500 has halved. Some of you on this phone call, on this webinar tonight, were born before January 1973. The guy giving the webinar is definitely one of them, right? So I've seen it 3 times, right? Here's the trick, right? Here's the magic trick. We need to normalize these market corrections. These are not end of the world events. I'm here to tell you, this is normal. This is normal market behavior. These are not crises. These are completely natural, completely normal stages of the market cycle. They happen all the time. These zigs facilitate the zags. And we have to sit there and have faith that the upward zag will always come. The zigs and the zags, the ups and the downs, right? Stock market is up 50x in the last 55 years. And what did you have to do to get that 50x return? What was this magic ingredient that you had to have to get a 50x return on your money over the last 55 years? Nothing. You didn't have to do anything. Just had to sit there. Do nothing, right? It's like the old joke about the army. Hurry up and wait. Yeah, hurry up and get the money invested, and then don't do anything. Just sit there. But Americans can't do that. Most investors around the world, but Americans especially, can't do it. We can't tell the difference between volatility and risk. And all the noise, and it's harder today. It's not easier today to be an investor, because of all the noise these days. It just makes it harder. It was actually easier. I believe it was easier 30 or 40 years ago, before the internet, before cable news channels, before your cell phone, when you actually had to call like a stockbroker up and get a quote, or wait for the newspaper to come tomorrow and read what your stocks did during the day, right? Today, you have salesmen telling people, we have all the tools you need to be a successful investor and beat the market. Download our app and pay $15 a month. Yeah, okay, great. Good luck with that. I have a great tool too. I actually know what this tool is to help you beat the market. It's called earplugs, right? That's the tool, right? Earplugs. Put the earplugs in, go outside for a walk, right? It's not your laptop, right? Here, buy good earplugs, stop listening to the noise, invest in good stuff, and just leave it alone. It's a simple concept, almost impossible to do because of all the noise in our lives today. The cell phones are just brutal, right? So that brings us to one of my favorite stories. The day that little Warren Buffett lost $347 million, except that he really didn't, right? There's the man himself, good old Snowball, all right? So what does this mean, the day Warren Buffett lost $347 million, except that he really didn't? Look at those dates. Friday, October 16th, 1987, Monday, October 19th, 1987, 35 years ago. That was actually the day that that was like the genesis of Bodnar Financial, really. It was because of that day, that Monday, October 19th, 1987, that I decided to leave where I was and open my own firm the following January, 1988, right? 35, we just celebrated the 35th anniversary, right? So Warren Buffett, that blue line there, that was the price. See the $3,890? Warren Buffett's company called Berkshire Hathaway, him and Charlie Munger founded it, right? Berkshire Hathaway, Inc., one share of stock was worth $3,890 at the close on Friday, October 16th, 1987. The next trading day, Monday, the stock market opened, and still to this day, it was the single worst day in the history of the New York Stock Exchange, right? The Dow Jones Industrials and the S&P 500 dropped 20% for the day. And it wasn't even a full day. It got so crazy and so bad that like sometime between 12 noon and 1 o'clock, I think around 1 o'clock in the afternoon, the New York Stock Exchange shut itself down and said, you know what, it's too crazy. We can't handle the order flow. Everybody go home, go to the bar, have a drink, and then go home, and we'll see you tomorrow, right? It literally wasn't even a full trading day. Who knows what it would have closed if they hadn't shut the market down. So the market dropped 20% in one day. So if you did the math, right, Warren Buffett and Charlie Munger lost $347 million in one day, except that they really didn't, right? Why? What do you think Warren Buffett did on Black Monday? Do you think he panicked and he sold? Of course not, right? He wrote it out. In fact, if he could have gotten away with it, he would have bought more, probably, right? He would have looked at this and said, man, this is like the day after Christmas sale. I'm going to buy some more Berkshire Hathaway. So if you still have your pencil there, jot down on the piece of paper what you think those shares that were $3,180 a share on Monday, October 19th. What do you think they were worth, or were worth exactly 35 years later on October 19th, 2022? There you go. See the green one? How about, that's not a misprint. This is like the crazy, this is a real life example of like the $15,000 is now worth 12 million, right? Here it is in real life. If you owned one share of Berkshire Hathaway, Monday, October 19th, 3,180. Or if you had bad luck and you said, oh, geez, I bought it on Friday, and wouldn't you know, the next trading day, I lost 20% in one day. Like you were Louis the loser with the worst possible timing, right? Let's say you bought it on Friday. It doesn't look so bad that one share that you paid $3,890 for is today, well, not even today, 35 years later, is 421,610. Because actually, I just looked it up before we got on this, the market closed at 4. One share of Berkshire Hathaway today is up another $35,000 over this 421. Today, Berkshire Hathaway closed at $457,665 a share, right? So, this is the story of the day. The story of Warren Buffett lost $347 million in one day, except that he really didn't, because now he's a billionaire, right? So what's the moral? Why do we tell this story? Because the moral of the story is you have to stay in it to win it. You have to go against your human nature. I remember the phone calls I got and the panic on that day. And you have to go against human nature. You got to fight the fear. And that's not easy to do. It's very, very hard to do. You would not be human. All right. You would not be human if you did not feel fear when, as it would have done 13 times since 1946, right? You wouldn't be human if you watched an average of a third of your invested capital melt away in a bear market, and nobody anywhere could tell you where or even how it would end. I'm telling you, it's okay to feel that fear, because if you didn't, you wouldn't be human. But I'm also telling you that if history is any guide, and it's about the only guide I know, that what's not okay is to act on that fear. Feel the fear, but don't act on it. Do not act on that fear, and to liquidate. Do not liquidate your long-term portfolio in a panic, right? That's what I really do for a living. I mean, we do financial planning, we do all this stuff, but honestly, it's more like I am a financial psychiatrist, right? As your financial advisor, but also as your financial psychiatrist, I'm here to help you deal with the feelings. I'm here to empathize with you as you feel the fear. You're going to feel the fear, especially if it's your first time through it, right? You're going to feel the fear, and I have to help you decide not to act on that fear, right? That's what we do, right? So, I think we're kind of at the end of 45 minutes or so, right? So, I want to thank you for being here tonight. All you hanging in there. I can see the number of participants hasn't really gone down, so I didn't bore them to death. Jack, I hope you found this helpful. Myself and Justin and the whole team, we're here to answer any questions you might have. If we haven't met in a while, call the office. It means we're probably due for an annual review. All right. And last but not least, I leave you with a message from the lawyers, right? Because if we're going to post it, there it is, the classic securities offered, opinions voiced, hypothetical examples. I love the last one. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. That's a message from our sponsor, the lawyers in the crowd. All right. So thanks for coming. Great night. And we will see you again soon.